Hi everybody, I'm here today with Paul Nelson from Fresh Finance. Welcome, Paul.
Thanks for having me, Michael.
Yeah, and we're talking everything finance, interest rates, obviously from our end, a bit of what's happening with the ATO. Paul, I guess the first question I've got for you, mate, is we're hearing a lot about interest rates. It seems to be, in addition to sort of Sydney real estate, it seems to be the hottest topic at sort of cafes and certainly in the press. What are you seeing at the moment, and what do you think's coming for us in terms of interest rates?
Yeah, you're right, Michael. It's certainly front page news and at the front of a lot of people's thoughts at the moment, especially those that have a mortgage. What we're sort of thinking is after 10 consecutive rate rises, we're pretty certain we're nearing the end. Um, the rhetoric out of the RBA was that, where there might be one or two more to come. We're sort of hoping one more and then a pause. If not, there'll be two more and then a pause. And a lot of the data is pointing to that becoming true. So yeah, we're quite optimistic that we're definitely near the end of it. And I think the biggest factor that we're seeing across our client base at the moment is there's approximately 30% of all mortgages on a fixed rate, and they are all looking, no, not all, but a large percentage of those are coming off fixed rates this year. So for the first time in a long time, a lot of people are sort of having to contemplate going from a rate of, say 2% up to 5 or 6%. So whilst, the rate rises have impacted a lot of people, there's still around 30% of borrowers that haven't quite felt that yet, which we think might be playing into some of that, stubborn inflation. People just haven't had to adjust as yet. So we're taking a lot of calls at the moment from people on a fixed rate and talking about what they can do when they roll off that fixed rate, because it's going to be a large portion of people in Australia that are going through that at the moment.
And I take it there's, with those people that are ringing you, there's solutions. I assume there's refinancing options. There's going back to existing lenders to try and renegotiate those fixed rates. How are lenders sort of looking at that?
Yeah, I would say, one piece of advice is to make sure you reach out to your lender or to a mortgage broker. Because the way the fixed rates tend to work is when you sign up for the fixed rate, deep down in the documentation, when you roll off to a variable rate, you just roll off to the bank's standard variable rate, and they can be, at the moment, they're up around 7 or 8% with no discount. So people that aren't sort of on top of it or aren't across it, will roll off to that 7 or 8%. So yeah, my advice is just make sure you're talking to somebody, whether it's your existing bank, about what their best deal is when you roll off, or a mortgage broker to go out and get you some more options. But you're right, refinancing is a big part of our business at the moment, just because people are looking to save money wherever they can, and that's one way that they can do it. And for you, Michael, we're hearing in the market that things have changed over the past few months with the ATO. Are they getting much tougher on collecting tax debts at the moment? What are your thoughts around that?
Yeah, look, 100%. It's funny, we do, as you probably know, we do a bit of this, and every time I seem to have one of these conversations, I guess the rules have changed again, and they've changed again even in the last couple of weeks. But look, there's no question if you roll back over the last sort of 6 to 9 months, the ATO have definitely gotten tougher. What they've really done is hit I guess, the go button on directors and chasing directors personally for ATO debt. What we're seeing, particularly in the last few weeks, is that they've now supplemented that with they've restarted winding up application against businesses. We were seeing garnishee notices. So it's really that full range of collection activity that we were familiar with pre-COVID, but there's certainly it's at a much higher level than it was pre-COVID, and there's obvious reasons for that. Prior to COVID, the ATO uncontested or undisputed debt was around 23 billion. Officially, it's around 45 billion as at 30 June last year, but we know from sort of our sources that it's probably closer to 60 and maybe even higher than $60 billion. So there's a desire from the ATO to get this in. In fact, there's a pressure on the Commissioner to do this. But look, the good news is, it's not all doom and gloom. The ATO are working with us to help businesses get out the other side of it. We're finding that they're being a lot more flexible now in terms of what they will and won't do. They're tough, there's no question about it, but if you engage properly with them and you put something to them that that they can approve, and you put it in a form and you meet, the ATO has quite strict legal practice guidelines, and they're applying those strictly now. But if you understand those and meet those, and we're a little bit weird in our business, we like reading that stuff, and for anybody who's listening, if you can't sleep at night one night, then feel free to go onto the ATO website and have a read, and you'll certainly put you to sleep fairly quickly. But they're really doing that. But if you do it, they will work with us, and we're getting some great outcomes for clients. So, yeah, so look, interesting times. And I guess leads on to probably the thing I'd be interested from your perspective, Paul, being from that sort of finance side of things, is, in terms of funding either businesses that have ATO debt or even funding businesses for ATO debt, what I guess the lender appetite is for that sort of business at the moment.
It's something that's sort of coming across our desk a lot at the moment. As you've said, the ATO activity ramping up. More and more people are in this situation. So, a few years ago it was sort of frowned upon. Like I don't know, people did their best to try and hide their ATO issues when talking to lenders. Whereas now, it's not like that anymore. There's some lenders that would prefer it all be tidied up before
I guess
they would.
The Big Four are they're probably the obvious choice about having little appetite for this. But the great thing certainly we're seeing is there are so many lenders in the market now that are comfortable with it.
Yeah. We sort of call them the second tier lenders, but it's not second tier in terms of any worse experience
Same dollars.
or same dollars, and they can solve a lot of problems. Sometimes the interest rate is a little bit higher when talking to these lenders, but at the end of the day, it's the solution that most people are after. So yeah, we have good success with people like RedZ, Bluestone, Pepper, and even some of the majors now. As long as you're upfront about it and there's a good story around the exit strategy or what the tax debt was for, and how the next few years looks for that person or that business, they are open to it. It's just about building the story and making sure you sort of take the bank along with the journey. But yeah, it's definitely not. If people do have tax debt and they would prefer to borrow the money to pay it out, or they have to borrow the money, it's certainly something that we do quite a lot of, and there's a lot of options out there for people.
Yeah, look, and I think that's right. Certainly with the clients that we see, there's essentially two ways that they can clear their ATO debt. Well, three if you include insolvency, but we keep our clients well away from that. It's either to, if they can support it through cash flow, but if they can't, then, they need to bring some funding into the business. And that's why, we love working with you guys, because you understand this area, you're comfortable with it, your lenders are comfortable with it, and, between us, we get an outcome for the client.
Yeah, that's right. And if a client does have an ATO debt and they want to get you guys involved, how does that work from your side of it?
Yeah, really, really simple. We try to keep it as simple as possible. We're virtually 100% referral based. Some people do find us through sort of SEO searches and stuff, but we work hand in hand with other advisors, be they accountants, funders, brokers, and we're part of, I guess, and I sort of mentioned that earlier, we're part of a team to get the business and when we talk about a business, we're talking about human beings and people and families and homes and everything at stake. So our objective is to work hand in hand with the other advisors to get them out the other side, and that generally involves an involvement from all of us. We need assistance from the accountant in terms of getting some of the financial information together. If there's a funding requirement, then obviously we need help from the broker and the funder around all of that. But look, we keep it as simple as possible. If if you have a client that needs our assistance, it's just a simple email introduction. We then engage with them. We recognise that whoever sort of sent them to us, that their client, we work around that, and with every client we do quite a detailed review of their position, because what we find often is that where people think they are with the ATO is often not the case. Sometimes it's worse. Most often it's most often it's worse. Sometimes it's a little bit better, but we generally find people are probably in a bit tougher situation than they realise, because the ATO don't always sort of bang the drums as loudly as maybe they could. So we do that review. We work out exactly what they need. We work out how to get them out the other side and discuss that with their advisors, and then we provide a fee estimate, and it's all fixed and everybody knows what they're doing up front, and we do all that at no cost. So it means that there's no impediment for somebody to send somebody to us to at least review the situation. I had one just now, and it's come from one of the sort of mid-tier accounting firms, and they'd like a second look at it to see if we can improve the situation, and that's exactly what we're going to do. We'll do the review, and I think with that client we can improve their situation quite significantly. So, but as I said, we do that all at no cost, because a vast majority, 95% plus, once they see the options and see what we can achieve, and our aim is at the end of it, the business is left in a far better position with the ATO, owes less debt, and I guess is cash flow positive after sort of meeting our fees.
Yeah, I know the clients that you've worked with us have been amazed at the results, and it's been such a good experience.
Yeah,
So,
thank you. Yeah, it's great. And look, we do this because we love helping people. I had a gentleman in my boardroom yesterday, 48 years old, and a plumber, runs quite a successful plumbing business, in tears, because he'd been dealing with this for 18 months. Unfortunately, in that situation, his accountant, who was unfortunately his best mate, had let him down. So it's not always the accountant's fault, but I think in this case it kind of, that's where it sat, and it's always the way when you get your mates to help you. Sometimes you go to the bottom of the list. But now he's got a good accountant involved, and they're helping him. But to see the level of stress and the impact it was having on him and his family was quite upsetting. And we keep a box of tissues in the boardroom because we need them from time to time. But even just having spent 45 minutes with him, showing him that there is a way out of this, that he doesn't have to lose his home, he doesn't have to lose his business, because if the business went under, he loses his license to trade, and there's a whole bunch of stuff, because it's quite specialised work that he does, with a lot of government contracts. So I think we knocked about 5 years off how he looked, and we've still got a little way to get him back to 48, but his blood pressure came down about 20 or 30 sort of increments, or whatever they measure it on these days.
Wow.
I guess probably the other thing too, Paul, while we're talking about this, because we are talking about people that sort of are doing it a little bit tough, and affordability is a big issue in the economy. Costs are going up all the time. We're talking about 30% increase in energy costs, and supermarkets, you go there, you don't get a lot for $50 these days. So I guess, but where you understand and where your expertise is in that sort of finance space, and dealing with people with both commercial and residential funding, and what you're seeing people are doing, I guess, to mitigate this cost and I guess sort of stabilise things a little bit until they can I guess adjust their businesses to meet those costs.
Yeah, it's another hot topic, and it's something that we're dealing with on a daily basis. And some people might have heard of the term, various people call it the mortgage prison. So, somebody might have taken a loan out a couple of years ago, and the rates they were assessed on were 2 or 3%, and it was all good. Whereas now, to look to refinance somebody at the moment, we have to assess it at 3% plus their actual rate. So, we're looking at assessment levels of sort of 8 or 9%. So for a lot of people, they are in a mortgage prison. They can't look to refinance because they're sort of stuck with their current bank. So we're doing a lot of work with people around that. So trying to improve the position of how we can present it to a bank. So simple things like reducing credit card limits, paying out car loans, just looking at your spending, trying to sort of massage that where we can. So things like that help. But the big one that we're sort of hoping will come in later in the year is APRA reducing that 3% buffer down to, we're hoping sort of 2%. And that will probably get a lot of people out of the mortgage prison. And I think APRA are just sort of not wanting to do that at the moment because they don't want to add more fuel to the inflation fire. But as rates stabilise, and APRA feels bit more confident that we're at the peak of the rates, we're hoping that they'll reduce that buffer down to allow people a bit more freedom to pick and choose which lender they go to. Because I don't think it's the intention of APRA to have people locked into the one lender, especially if there's a better deal out there somewhere else. So we're seeing people being able to save 1% or 2% by switching lenders. So just encourage people to just find out what your interest rate is, talk to a broker, talk to your bank about what deals they've got, and see what you can do. So people are certainly, as you said, looking to save money where they can, because their electricity's up, their grocery bill's up, their petrol's up. You also don't need to be paying the highest interest rate for your mortgage. So a lot of refinance activity at the moment.
Yeah, I would have thought sort of working in the finance industry is probably, as I sort of made that comment earlier on, that, the sport used to be sitting at a cafe on a Sunday morning talking about Sydney or Melbourne or Brisbane house prices, and that was kind of what everybody was talking about. But now, certainly from the conversations I'm having is that I've never seen people, when you ask somebody, well, what's your mortgage rate? And they go, I have no idea. I've never seen people so aware of their mortgage rate as now. Probably one other thing I'd be interested in your thoughts on, Paul, is, we talked before about a lot of loans are coming off fixed rates. I also expect that there is, and I saw a stat the other day, that there's a huge number of loans not only coming off fixed rates, but coming off interest only. And and I just personally, we had a loan that sort of did that recently, and even though weirdly it was fully offset and we were paying nothing, the jump from interest only to principal and interest was enormous.
Yeah, it's another issue for a lot of people, because the way the lenders try to look at the interest only, they're happy to advance it, but only once. So, if you get the loan and you're happy with the 3 years interest only, unless you're willing to move lenders, that lender doesn't normally like to extend it for another interest only period. So, it just falls back into that, what we've been talking about. Just be aware of it. Know when your interest only period's coming up. Talk to an advisor about what your intentions are. Some people are happy to go to a principal and interest type loan once the interest only period finishes, but in this environment where rates have jumped so much, to go from a repayment of maybe $2,000 to $6,000 or $7,000 on a principal interest basis, it just doesn't work for a lot of people, especially investors where the rents have been pretty steady. I mean, they're going up a little bit now, but a lot of people are in that boat, and just have to be aware of it and have to look at it.
I think one thing I'm hearing kind of loud and clear is that, again, it's probably more so than ever important for people to have sort of specialist help from people like yourself, because, when rates are low and everything's fairly stable, and, particularly if you don't have that sort of mortgage stress, it's easy just to deal directly with your bank. But in these times where it's a bit trickier, and, you mentioned there's the mortgage prison where people can't move lenders and everything, probably more so now than ever, that the sort of that specialist help is really more important than ever.
Yeah, definitely. And one final question for me, Michael, is if a business has ATO debt, when do you think is the best time to reach out to the ATO and start discussing?
Yeah, today is a simple answer. Look, and I'm being facetious, but I'm kind of not, and particularly given what I've said before about where the ATO is at the moment, they're moving really, really quickly. We're seeing, situations where the ATO are losing patience and they're issuing director penalty notices, and then when they expire after 21 days, bang, statutory demand straight away. And it's stuff. It's unlike what we've seen ever certainly in the sort of 10 or so years that I've been doing this. So the other thing around it too is that the ATO is quite structured in what they can do, and every taxpayer has a risk rating, and so that risk rating shifts over time, and there are things happening, and it's quite automated and run by sort of quite a sophisticated software system that the ATO use. So businesses are moving through that, and depending where you are on that debt recovery sort of scale within the ATO, also significantly affects not only just whether something's going to happen that might be nasty, but also what the ATO can do for a business or an individual. If you actually, engage, whether it's with your bank or with the ATO, there are good outcomes and good solutions that can be found, and both are wanting to work with people. So so I just encourage anybody to, whoever's watching this, or if you're an advisor, then get in and talk to your people, talk to your clients, and get them in action around any of these issues as soon as possible.
Yeah, I couldn't agree more. Thanks for having me, Michael.
Perfect. Thanks. Cheers.
Thank you.